For a melt-up rally. That is what our next guest is calling for in the months ahead. He is Tom Lee. He is FundStrat's co-founder and the head of research, also a CNBC contributor. And as you see, he's here at Post 9. Nice to have you.
Great to see you,
Just
Scott.
saw Dietrich on. He's bullish. And you are too, but you say too many people are not.
Yeah, you'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio managers, many are still cautious because they see tariff risks ahead and they don't have tariff resolution in hand and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
What role do tariffs play in all of the way you're thinking about the market?
Well, tariffs matter. Remember, before February, before Trump sort of talked about this, the base case for many was a 15% tariff. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80, and we wouldn't say $80 oil breaks the economy anymore. So I think tariffs aren't, we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug-in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's an event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
So if for argument's sake, the tax bill ends up not as big as the price tag is on it now, would that be a positive taken by the market? Maybe the bond market would feel pretty good about that, wouldn't it?
Yeah, I mean, Scott, it's kind of hard to say because I could see it being if bonds rally, that's good for equities. But if this tax bill leads to more spending, even if yields rise, markets are going to focus on the earnings effect. So I'm just going to say it could go either way. I mean, it could be bad or it could be good.
When you hear Jamie Dimon talk about there will be cracks in the bond market, do you just brush that off as that, I would expect someone in Jamie's position to be talking about the risks that are in the system? Or do you sit back and say, well, maybe that first little scream from the bond market was before there's a full-on tantrum, which wouldn't be good for equities in any way?
Well, JP Morgan has a dashboard to the U.S. economy because they see consumer credit. They see it real time. We know consumer credit delinquencies are rising and auto loan delinquencies are rising. But is that going to spill over into the broader credit market to create a credit event? The one market we watch is high yield. High yield spreads have actually managed to hold on to most of the rally gains, and they've retraced 70% of the widening. That's a market that says the economy actually is starting to strengthen.
So you don't put that much cred into bigger worries about the bond market having an issue anytime soon. And even for accuracy's sake, I mean, it's not like he said we're going to have this issue tomorrow. I don't know if it's 6 weeks, 6 months, 6 years. I'm paraphrasing, but that's generally what he said.
Yeah, I mean, I think Jamie's flagging that there are parts of the economy that are weak, including housing. I mean, housing is deteriorating very quickly, but that's also going to deliver a pretty big deflationary pulse. That was 75% of the rise in inflation since 2019 is housing and auto services. So if housing is turning down on price because there's supply, I would argue that's a structural decline in inflation. The Fed would actually have to be quite dovish in the next 12 months. That's bullish.
Submit their best offers by tomorrow with the July 8th tariff deadline looming. It's a global game of economic chicken, and the White House says it's done waiting. Hello, everyone. Welcome to the Big Money Show. I'm Jackie DeAngelis. With me are my co-hosts Taylor Riggs, Jerry Willis, in for Dagan McDowell, Brian Bremberg, and with us for the entire hour, Prairie Operating Company EVP of Market Strategy, Lou Bassanese. So let's get back to this. Lower tariffs, fairer quotas, and real enforcement on everything from digital trade to critical minerals. Those are the demands coming from Washington. And Trump is turning up the pressure himself, writing this on Truth Social. If other countries are allowed to use tariffs against us and we're not allowed to counter them, our country doesn't even have a small chance of economic survival. Sources say deals with allies like India might be within our reach, but for others, especially in Europe and Asia, we could be shaping up for quite a showdown. So I have gone through this, Lou Bassanese, and I've said that list of tariffs he was holding right there was not really a real list, that this was all about negotiation. When the UK deal came in, I was optimistic. When China pause came in, I thought, okay, things are going well. When he said we're having trouble with the EU, I said, Houston, we have a problem. And this signifies to me that there is a bigger problem.
I do. I think you said it rightly. It's a game of chicken, and he's really having to take a stronger stance. But I got to give you credit. Long ago, when he was awaiting inauguration, you said he's carrying a big stick with tariff talk. And I think we're seeing that again. And countries need to wake up. I mean, it's a July 8th deadline, and we're here. It's June 3rd, right? So he knows he needs to get the ball moving in the right direction, shift momentum. Because I'm with you. China seemed like a great deal. This seemed like momentum was happening, and now it's slowing down. EU, understandably, is going to be hard. You're talking with 27 different countries. Someone is going to feel like they're being neglected in that. But time is of the essence. I think the president is right to push the issue, force it now, and use all means possible. I mean, who would have thought social media could have such an influence on international affairs and economic policy?
Yeah, I get what he's trying to do here, but I also am of the school that ultimatums sometimes can really backfire in your face. You have to be careful. Taylor, when we're looking at the countries that are the most difficult to negotiate with, I would probably say China and the EU top the list. So you're looking at some of that.
So this is very interesting, you guys. We've talked a lot about who needs who more. Does China need the U.S. more? Do they fold first? Do they blink first in this game of chicken? We got China private sector manufacturing numbers out overnight. And lo and behold, they slide into contractionary territory from expansion territory. Gauge for new export orders in China drops to the lowest level since July of 23. Employment declines, prices low as supply and demand weakens. Here's another quote from manufacturers in China. Unfavorable factors affecting China's economic development remain prevalent. External trade environment uncertainty has increased. Downward pressure on the economy has intensified relative to recent periods. And then lo and behold, what Morgan Stanley, our favorite U.S. bank, Brian, by some measures, has to say about the U.S. economy. To our surprise, U.S. manufacturing construction starts up in the first quarter. My chart of the day shows that U.S. manufacturing construction tracking 250% higher relative to 2019 levels. So again, one note, one data point. But I come out this morning and I'm thinking, wow, it looks pretty negative for China, and I'm only reading positive stuff. There's another volatile level of GDP that we don't talk about because it's so volatile, but it's showing very high growth so far in the second quarter for the U.S. So again, in the game of chicken, who needs who more?
Well, I think the data points keep piling up, though. I did the math, and China would suffer a 2.2% drag on GDP if they don't resolve things with the U.S. Now, we're talking about they're trying to maintain 5%, basically cutting it in half. They need us way more. As you're citing, the U.S. economy is reaccelerating.
Yeah, you don't want the factories there to slow. We've already seen rumblings of the natives getting restless as a result of this back and forth. But the Truth Social post coming from Donald Trump is quite intriguing to me because he makes an interesting point. Other countries are using tariffs on us, yet we're limited here in the United States. He's been challenged in the court system of whether or not he can use emergency powers, Brian, in order to enact the tariffs that he wants to. Obviously, you've highlighted there are several tariff tools that he has in the toolbox he can use, but they're not as extensive as he would like them to be. And so we do have to ask ourselves, are our rules to a certain degree limiting?
Well, he's got more power on tariffs than any president in the history of this country. I mean, the grand sweep of tariffs in America has been Congress giving more of that power to the executive. So he's in a pretty good spot. Now, Donald Trump always takes everything he can get. He doesn't take the Brenberg approach, which is, man, I've still got a lot of other things I could do, right? He takes the Trump approach, which is, I want everything. He wants 301, 232, whatever the one Dagan said yesterday was. He wants IEEPA. He wants it all. Okay. I think he's in a good spot. I'm a little more positive on the ultimatum than you. I get it. The ultimatums I give to my kids backfire often.
Generally not good, right?
I can second that.
Donald Trump is better at ultimatums than I am. And I think he's going to these countries and he's saying, let's get this moving on Trump time. You're now on Trump time. You've sat around and thought about it. You've sort of tested where the wind is blowing. Let's make a deal. Give me your best offer. We'll tell you if it's good enough.
Yeah.
But I like that. This is a good time. If you're right, and China always lies about their numbers, but if they're telling you manufacturing soft, then it's bad.
Yeah.
Okay? In the U.S., we keep getting these surprising numbers like, oh my gosh, unemployment's good. Oh my gosh, inflation's good. Oh my gosh, manufacturing's come back. It's a good time for the U.S. to use that leverage and get something done. So I like what he's doing with this.
But can I say just one thing here? Yes. It's not just China and the EU and other countries. It's also the stock market and investors who play a role in how fast this has to go. And it's going to be interesting to see, I think, just how patient the market will be going forward, because I think they're going to want this wrapped up. You know how the market is. It's like, okay, are we done yet? Can we move on? Earnings are out. Okay, bye. They want it fast. They want it done.
Do you think they're kind of done, though? I mean, we got that. You were talking about the EU thing on Friday, right?
Mm-hmm.
Like, Houston, we have a problem. And the market was, dropped for a bit.
We're just
back.
I think the market's been pretty good about this, to be perfectly honest with you. Now that the initial gut punch, the shock has worn off, and they know Trump is in a Trump speed. Trump speed kind of negotiation right now. They're taking it on the chin here. I think the rest of the data has been pretty encouraging, and so have earnings. And so the market is saying, it looks at the neighbors. Taylor, you point out those that we're negotiating with and the positions that they're in, and is saying this is still the best house in, a crummy neighborhood right now.
They continue to analyze it that way. And they give them some.
But data keeps coming in. I mean, if we look at earnings, right, analysts got really negative and only expected 6% growth. They came in at 12.9% for the quarter. So like Brian was saying, all these reports keep coming in unexpectedly positive or more positive than we thought originally. Mm-hmm. And the stage is set for that to continue. I mean, we're seeing companies that are absorbing the tariff pressure, sacrificing some margins. They're still seeing demand. Retail reporting, we were talking about this last week. The retailers came out without an exception almost, maybe Walmart, the only one, really strong reports that the consumer is there. So.
You also have the prospect of the big, beautiful bill and tax cuts passing, and I think that's holding this market up as well, because it's optimistic that the plan, all the spokes in the wheel are finally coming together, and this is what he promised. We're going to be talking later in the show about the consumer. We're going to be talking later in the show about some of the new energy projects, all these different things that have to come together to float this economy. But right now, even despite the fact that we're in a negotiation, so far so good.
You talked about earnings growth. My estimates had 13.1%.
The official Taylor Riggs estimate,
0.2% higher than you, but I'm Pollyanna, so maybe we'll attribute it to that. That's not relative to revisions. That is literally earnings growth year over year, taking all the revisions out of it. I mean, that is solid and healthy. And as long as that grows above the long-term median, which is about 7%, valuations price higher goes up 90% of the time and by 9% on average. Not saying everything is in the clear and we're all going higher, but the fundamentals so far have held up phenomenally well.
And that's really important, because if you have fundamentals like that you're building on, and they want to get the growth engine going, that's what's going to pay for the tax cuts and the big, beautiful bill, or at least the part that the spending cuts don't pay for. You've got a good case to make that growth is going to be higher than a lot of the estimates out there. That's what I think is being priced in right now.
I hear a really strong case to not freak out about tariffs. Like, that is my day by day lesson in this is, I don't think businesses are freaking out as much as the financial press. I don't think investors are freaking out the way everybody thought they were going to. I know that there's some news outlets that would love to see all of this fall apart. But I don't think most of America wants to see it fall apart, and that's why it's not falling apart.
So is it not freak out about the tariffs because it's all going to turn out well, or is it don't freak out about the tariffs because ultimately nothing's going to happen?
I would say two reasons. One is I don't think tariffs are going to have as much impact on our overall economy as people say they are. I mean, 80% of our economy is a domestic economy, okay? I think that's one of them. I think the other one is President Trump doesn't want to destroy the American economy. He doesn't want to destroy American capital. He wants to see it win in the globe. And so I think he's going to ultimately do things that benefit growth and prosperity in the country. And if you believe those two, if you recognize the first thing, that our economy is very domestic in a lot of ways, and if you believe the second, which is you've got a president who loves economic growth, I think you're going to be okay.
And if he comes to the 10% baseline that we've been saying the market's probably expecting, and most people are expecting now, he generates some tariff revenue, which is something that he wanted to do. And when you cobble that all together, all those savings, $200 billion here, $175 billion with Doge, you've got his gold card initiative that's coming out. You start adding up those numbers, and they actually are pretty impactful, especially on the Doge side when you're cutting a lot of waste. So I think that he reaches his objective. He had to go hard and high when he started to be able to get the conversation going.
Yeah, and don't lose sight of the fact that Brian's point, we have a domestic economy largely, and tariffs only impact goods, right? And personal consumption, 2/3 of that spending is on services. So we're talking about tariffs impacting 1/3 of consumer spending, not the entire thing. Right. So it's really a smaller impact than most people or most news outlets have tried to make it out to be.
Absolutely. Meantime, we're looking at stocks today. And Taylor, you're watching Signet.
You guys, how can we not do this one, right? All the jewelry makers like Signet up 10%. Remember, Signet owns Kay, Jared, and Zales. And there is a new fad out there on lab-grown diamonds. Man-made diamonds, not a cubic zirconium, that literally the biology of the diamond is the same as an earth-made one, but you just grow it in a lab, but it's like a fraction of the cost. So Signet Jewelers is saying that they're adding more lab-grown diamonds to their fashion jewelry assortment, because if you don't want to buy a real engagement ring, you could buy a lab-grown diamond, but if you want something higher than just fashion jewelry of like a cubic zirconium, lab-grown diamonds are double the price of that, which is helping them, and higher gold prices are helping them. So lab-grown diamonds is this very interesting sort of middle-of-the-road niche that they're really tapping into.
Yeah,
you're nodding.
No, I'm nodding because there used to be another company that was trying to forge their way in this market. It was in between cubic zirconia and lab-grown, and about 5-6 years ago, it was a small-cap company that just couldn't get traction. It's funny how consumer tastes adjust, and now it's okay. You're saving 30 to 40% on average off a typical diamond. You get more bling for your buck. I think
and
that is.
But it's lower end. You cannot tell the difference.
You're talking about Kay Jewelers and Zales. De Beers just said they're not going to be producing any more lab-grown diamonds. Higher end.
Tiffany's won't either.
Be,
really?
Associated with it.
There's definitely a certain market for it, and it's hard with lab-grown diamonds. There isn't a resale value. You don't know what. If I wanted to trade up, what is that market?
Why would someone buy your used lab-grown diamond when they could go buy a new lab-grown diamond?
Brian and I are really into this stuff.
Well, I just, the main problem with lab-grown diamonds is the name lab-grown diamond.
You're thinking lab-grown
It's the but. The biology is the same, but.
Yeah.
They need a better name, though. It can't be lab-grown.
Fake would be worse.
Man-made.
That doesn't do it for me. Keep working on it. Get back to me on that. We need a better name.
Biologically engineered. Like GMOs.
Like your food.
Which we love. All right, coming up.
Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, we have some movement to the upside, a little bit of a kick up there. You've got your tech-heavy NASDAQ up 0.4%, your S&P 500 up just above the flat line here. Flipping it over to the bond market here, taking a look at yields moving to the downside, perhaps a reaction to some of the economic data that's crossing the wire right now. And finally, we're going to take a look over at Bitcoin moving to the upside. It's up above 105,000, up over 1.5%. I want to bring in my guest host for the hour, Stephanie Roth, Wolfe Research Chief Economist. Stephanie, we've got some breaking news crossing the wire here. job openings and labor turnover data. So let me break that data for us. The job openings labor turnover survey coming out right now, coming in a touch hot. The survey indicating 7.1 million open jobs, coming in just above that at 7.39 million here. So that is a beat again of that estimate here. The prior month revised to 7.2 million. That's a revision upward for job openings. Also the job opening rate coming in at 4.4% versus the prior month of 4.3. Also interesting to look at the quits rate, an indication of maybe how stable the broader market is, coming in at 2% versus the prior 2.1%. So just a tick lower. 1.786 million workers fired or laid off. That is also a tick up. So let's break down all of the data I just talked through with you, Stephanie. Talk to me about how you read this latest JOLTS report.
Yeah, so when I'm looking at this report, I pay most attention to the quits rate and then the layoffs rate as well. The openings rate, sure, it's important to pay attention to, but that can be a little bit more flimsy of a measure. It's easy to post a job opening, but a quit is something that's tangible. If you really feel good about your job, you're more likely to quit, and you're likely to stay put if you're concerned about the outlook to some extent. So we did get, the moves are very modest. We got a modest tick down in the quits rate, which just signals at the margin a cooling off economy. Also important to notice, this is an April print. This is a slightly backward-looking report compared to what we're going to get on Friday, which is a May release.
Yeah.
So we already got the signals of the labor market for the month of April, and it was still kind of fine.
Yeah.
The layoffs tick up is something to keep an eye on, but it's still fairly low. But this is something that we're going to be watching closely, and to the extent that claims did tick up a little bit most recently, this is going to be an important thing to keep an eye on.
And to what degree does some of the data that you're seeing here feed into the non-farm payrolls print later this week?
Yeah, I mean, this is an entirely different survey, so it's important to keep an eye on the fact that this is very much an independent measure of the labor market. It's not seen as important of a release. Again, like I mentioned, it's slightly backward-looking, but it filters into the overall mosaic of the labor market, and it just tells you that so far the labor market seems to be okay. We're not seeing any dramatic moves in either direction. Base cases will start to see a gradual slowing throughout the course of this year of payrolls growth, that we're going to get a slowing below 100,000, which is an important indication. And this is going to be driven largely because of immigration slowing down, rather than a real cooling of the economy.
Yeah, and that's something else that I want to talk to you about later on in the hour. We're going to talk about AI, and I want to get your thoughts on how immigration plays into the broader impact on the labor market here. I also do want to talk to you about the factory orders here. The survey indicating a decline of 3.2%. We actually saw a 3.7% decline in factory orders. Durable goods orders coming bang in line with estimates of a decline of 6.3%. Talk to me about that fall off in factory goods orders and durable goods orders. What is that signaling to you?
It's not something I would worry about too much. We got a big pull forward of demand in the month of March, and then you got a drawback in the month of April. This was volatility around tariffs. So I wouldn't spend that much attention kind of to this report. I wouldn't be too worried about it. In thinking about this report, the most important component is going to be your capital goods orders, non-defense ex-air, and shipments, same thing. And those are not that different from expectations. This is the final read for this report. We got a preliminary read earlier in the month, and the data aren't that different from that.
And I am curious, because you said something important in there about how the data is kind of backward looking, and we can kind of dismiss certain things because, tariffs were in place and it was pulled forward, but then, the tariffs are potentially going away, so then no data is important. Like, how do you find clarity on what data is actually important and accurate?
So I think there's a couple of things to consider. One, there was real concern that the tariffs would tip the economy into recession. Now that there's been a dramatic U-turn from the tariff perspective, I think we just have to look through a lot of it and smooth through the noise and just look at what the fundamentals of the economy are doing. Now, from March to April, there was a lot of volatility in the news. So it's going to be difficult to truly smooth through that. We have to just remember that there was a lot of pull forward in March, and you get a bit of an air pocket in April. So I would look at a 3-month average of the data as we move through the next couple of months, because that'll help you smooth through a lot of that volatility. It's going to be difficult, and it's going to be really hard, and this summer period of time is where you tend to get a lot of seasonal volatility, more so in the labor market, but it's going to create a muddied picture of the economy. And I think the thing to keep an eye on are people employed, and if they are, they're going to continue to spend. And that's been the case. The labor market has held up well. So the expectation is the consumption backdrop should remain okay as long as the sort of the dynamics of the labor market are still fairly firm.
And to that end, what are you anticipating for Friday's jobs report?
looking for 115,000. Consensus is closer to the 130,000, so a little bit below, but it should be okay. And we need to get accustomed to the jobs numbers coming in a lot slower than where we've been.
Yeah.
So we've been running, well over 200,000 for a lot of the past couple of years. And that was one, just catching up to the sort of the pre-COVID level.
Yeah.
And then it's also been immigration. The foreign-born labor force has driven a substantial portion of those gains. And now we're sort of closing the borders. And not only are we restricting the flow of people coming in, but also the stock of people, the people that are here, their visas are going to become expired. A lot of them who were here under Biden's parole programs. And these were programs that Biden brought in about 75,000 people per month on an ongoing basis. And we stopped the flow of those people from the programs, but also as those people's visas come due, the administration is not gonna extend them. And they're even trying to extend, to end a lot of those visas all at once. So Cuba, Haiti, Nicaragua, Venezuela was one program. And the Supreme Court just ruled last week that they can terminate all of those visas basically all overnight.
Yeah, and that, of course, to your point, is going to have a significant impact, one that we will be able to talk with you about to get some clarity. Thank you so much, Stephanie. You're going to stick with us for the rest of the hour here, but let's switch gears a little bit. Earnings season is almost over, and outlooks are actually improving. Analysts have stopped cutting their earnings estimates in the past few weeks. So what does this mean for markets? Joining us now, we got Kelly Kowalski, Mass Mutual Portfolio Manager. Kelly, really appreciate you making the time for us. What exactly is driving this renewed optimism, or at least decline of pessimism, about earnings growth for the rest of this year?
Well, good morning, Madison. Thanks for having me. I think that we've seen sort of as Stephanie remarked earlier, a big sort of U-turn from the administration in terms of a softening in policy. More encouragingly, we've seen an administration that is reacting to data and markets to some degree. So it feels like we've escaped from the worst case scenario. And I think if we can sort of get more clarity on what the trade situation is going to be, what this bill is going to look like, we may be able to sort of muddle through the next few months. If you look at overall S&P earnings, we're down to about 7% for the year. So there is some sort of already of that tariff sort of downside and the policy uncertainty baked in at this point.
And when you think about that policy being baked in, is that true across the board for stocks? I was reading a note this morning that tried to kind of differentiate between consumer-facing stocks versus CapEx-facing stocks, those big tech stocks that really rely on just company expenditures. Is it true for both of those different groups of companies that they are post-tariff in this environment?
Certainly, no, that's not what we're seeing. I don't think you can sort of bake in this level of uncertainty that we've seen. It's very unprecedented from the last several years. We know that, companies have, withdrawn guidance. Analysts are sort of doing the best they can to predict. Companies are still sort of frozen in terms of a lot of CapEx decisions, hiring decisions. But I think we kind of know at this point the overall tariff rate is probably going to settle somewhere around 15% overall. So that's probably where the market is feeling things right now.
So do you think looking ahead, the risk is that we could see a surprise on the upside because all the bad news is baked in, or is it the opposite? As we actually get the impact of that 15 percentage point higher tariff rate, companies have to actually feel that in their earnings.
Certainly, we've seen quite a bit of pessimism, and I think the bears, especially over the past several weeks post Liberation Day, have been proven wrong. So yeah, I think there is sort of an upside risk there as we think about getting past the trade uncertainty, getting the bill passed, thinking about potential productivity gains as we think about AI and those types of improvements, which, again, the time horizon is sort of uncertain there, but let's not forget that that's an overall tailwind as we think about the long-term economic outlook.
So when we think about the bill, honing in on that a little bit more, what areas of the market does that benefit most? Do we see it this year? Is it next year? Or is the impact not really that big and visible?
Well, I think there's two sides we have to talk about the bill. So we, at Mass Mutual, we're very focused on fixed income. So certainly we get a little bit nervous about the bill increasing the overall U.S. debt, which it is going to do to some degree. So we do see that as a risk to, Treasury yields. We've seen the bond vigilantes are back. Certainly the most beneficial impacts are from the accelerated depreciation, expensing of R&D, and then the consumption boost, we'll see that's TBD in terms of where the deduction ends up, whether we get this temporary boost in the child tax credit. I think a lot of Republicans in the Senate are certainly focused on that increase in the debt, as I alluded to. So that could change certain things like the SALT cap deduction and such, as they try to save some money and not run such large of a deficit over the next several years.
And Kelly, I am curious how you are thinking about the fixed income space a little bit more in regards to specific companies. In the notes that you sent over, you talked about Walmart as a potentially attractive opportunity for some investors. Talk to me about why.
Yeah, if you think about the Mass Mutual General Investment Account, we have a $285 billion account, and it's primarily high quality fixed income. So, and 95% of our bond portfolio is investment grade. So when we think about tariffs and uncertainty, we're bond investors. So is a company like Walmart, is our tariffs a challenge? Yes. From a credit perspective, is someone like that going to be able to weather this storm? Yes, they can. And we invest that way from sort of a long-term perspective. And when we make a credit investment, we're really thinking about what's the worst case scenario, and that's how we've weathered many different crises throughout the past several years.
And when I think about a company like Walmart too, I think about the kind of bifurcation of the consumer. And it was really interesting reading about how you do still see continued strength amid that higher income group. Is there anything that puts that higher income group at risk, or is that a narrative that investors can really continue to sink their teeth into?
Absolutely. You make a great point. The top 10% of income earners is driving 50% of consumer spending. And we've seen this trend, continue for the past several months. Certainly the lower income consumer is still struggling with higher prices and, potentially higher prices coming further with tariffs. We do see that trend hanging in there. Obviously, we have seen consumer spending soften a bit. I think we're encouraged with the markets going up post-Liberation Day. We know the wealth effect has been a big driver of consumer spending. So in the short term, we would expect that to continue. But what is holding this all together is really the labor market. And as long as the labor market hangs in there, we think that the consumer, which makes up 70% of the economy, can sustain.
What are your expectations for the labor market? Do you think it should continue to hold up? And then from a price perspective, when are these prices going to hit? And is that going to become an issue that derails the consumer?
I think similar consensus, we do expect to see a softer labor market as we get into the later months of this year. Think sort of, 50,000 to 100,000 average monthly payroll gains. And that's consistent with, the softened growth outlook that consensus has, as well as you saw the OECD just came out this morning with revised down growth forecasts. And that's what we'd expect against this lower growth backdrop. From an inflation standpoint, I don't think we've seen sort of the real impacts of tariffs come through yet to overall economic data. We may sort of see a one-time rise, as certain Fed officials have alluded to. But the hope is that is not a persistent rise. You would view it as sort of a one point change or 1 point in time change in the price level.
Kelly, really appreciate you joining us, and thanks to Stephanie for the great questions as well. Appreciate you both. Coming up, we're going to look at some of today's trending tickers. We'll give you the news behind those company moves next on Catalysts. It's now time for some of today's trending tickers. We are watching Hims & Hers, Joby Aviation, and Pinterest. First up, Hims & Hers announcing plans to acquire European telehealth platform Zava. The deal will expand the company's footprint in the UK and officially launch it into Germany, France, and Ireland. The all-cash acquisition expected to close in the second half of this year, those shares up over 3.5%. Next up, Joby Aviation exploring an agreement to sell up to 200 of its air taxis to a major Saudi Arabian investor. The potential deal could be worth as much as $1 billion and could help the company in its efforts to expand into the Middle East. And finally, Pinterest upgraded to overweight from neutral at JP Morgan. The analyst behind the call also raising the price target to $40, saying that diversification of the company's advertising platform does support further upside revenue going forward. You can see those shares up nearly 5%. You can scan the QR code below where you can track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're going to have all your markets action ahead, so stick around. You're watching Catalysts. We've got monthly sales data from several major automakers, including Ford, Hyundai, and Kia. Yahoo Finance senior autos reporter Praz Subramanian has the latest. Praz, let's start off with Ford. You said there was strength, by the way, across the board, but let's kick it off with Ford.
Yeah, so far. Big gains by Ford, but for how long is the question there. So Ford sales up 16%, led by trucks and SUVs. Hybrid surging too, still very popular amongst Ford customers in the U.S. Now, Ford introduced employee pricing right soon after the tariffs were announced. It was seen as sort of a cynical move, but it actually worked. They're eating into market gains. They're getting market gains there through that pricing program. So that's a good move there. The question is how long they can maintain that, right? Price hikes are coming. They've already said models made in Mexico, like the Maverick and the Mustang Mach-E, you're going to get price hikes too. So real quick, also the Korean automakers, Hyundai and Kia, both doing well. Hyundai up 8%, Kia up 5%. Hyundai kept pricing the same through June 2nd. June 3rd now. So the question is, how long are they going to raise prices? Are they going to keep the same? Can they even cut prices? We'll see.
And what are you hearing about how these companies are thinking through the price increases when the tariff policy continues to change?
I mean, the tariff policy for, at least with autos, has been the same. 25% since April 2nd or 3rd. Now, countries like the UK had a trade deal where they went to 10%, so that's helping them out. So the Koreans and in the USMCA, they're waiting for, can we get some pricing relief here from tariffs? It hasn't been the case so far. The ink is not yet dry or even wet on any of these deals. That's the big question. So I think you're right about with Hyundai and Kia in particular. They're trying to move as much production as they can to the U.S. and that's a tough move. So we'll see, because right now they're probably eating into their profit margins right now, but they don't want to lose customers. They want to lose market gains or some market share here, and that's sort of that balance, right? Is how do I maintain my market share without destroying my profits?
How much of the price increases can they actually pass through? Is it a portion of it, and then how many, percentage-wise? And are some automakers having a different perspective than others in terms of their plan here?
Yeah, so for instance, Porsche, for instance, has said that they want to pass on as much. Not they don't want to, but they're going to pass on as much as they can to the consumer, because they have a product set that people want, right? 911 sports cars are highly desirable. You can maybe pass on a good amount of that tariff price change to them. Cars in a competitive price set, volume cars, mid-market cars, you can't pass on that much to the consumer because they're going to get hit by another competitor. So that's the problem.
And to that end, which automakers stand to potentially use this as an opportunity to eke up market share from competitors by keeping prices low? Does anyone have that luxury?
So Ford just is blowing it out of the water because they did that employee pricing, and I heard other automakers complain about it. Like, why are they doing that? Well, I don't understand. This is why they're doing it, because they're seeing it as an opportunity to say, hey, Americans, we're going to help you out here. We know prices are coming. We're going to lower prices for you. And that was a good sort of PR, marketing, goodwill move by them. Hats off to them for doing that. Other automakers saying, we might want to preserve our sort of pricing power here and our profits here, and maybe do that later. Yeah. And maybe you'll see other automakers follow that in those footsteps. But right now, Ford warned of $1.5 billion in lost profits. GM almost potentially $5 billion without mitigation efforts in lost profits. So that's where we're standing.
Praz, really appreciate it. Amazing overview as always. Thank you so much.